Good evening, and thank you very much to Roland and the rest of the AJ Bell team. Very happy to be here to talk to you about our investment trust. I'm going to talk a little bit about who EJF Capital is. We're not exactly Aberdeen with a 142-year history of investment trust. So I'm explaining who EJF is. I'm going to talk a little bit about why now. Then we'll talk a little bit about the investment trust and its main holdings, and then we'll talk about the share discount and what we're dealing with that. We started our company 20 years ago. We're celebrating our 20th anniversary. We're based in the United States. You can tell by my accent. We do have an office here in London, so we have about 45 people total. We manage $5.5 billion. The trust is roughly in pounds. It's about 102 million pounds. So it's quite small from a trust standpoint, but it's part of our bigger and benefits from the bigger company that we manage. So our investor base is very institutional. This is the one product that we do have that's public, open to retail investors like yourselves. And we're very proud of the performance that we've had. We've been listed, we're just shy of 8 years as an investment trust here in the London market. About 25% of our investors are pensions. We have 3 sovereign wealth funds that invest with us. We're a very niche manager. We focus on U.S. financials, and in particular, the small bank and the small insurance company markets in the U.S. Very simple businesses. We'll get into why that makes sense and why we've been doing it for so long. If maybe you could turn to the first slide, please. Or the next page. Oh, that's me. Okay. There we go. So our track record. We listed in 2017, again, just shy of 8 years ago. We've had nice NAV return, our NAV return, which I think is very, very important. It's been a little over 9%. We own no equities. We're not allowed to own equities. This is all fixed income that we own. So I think that's a very attractive NAV return. I'll go into why there's not just income, but also some capital appreciation on things that we own in that small bank segment and small insurance company segment. On the share price, and we do trade at a discount, it's roughly 25%, which is staggering to us, given what we own and the asset class that we're in. But that's where it's trading right now. And I'll get to in a moment, but we own ourselves, EJF Capital, and affiliates, and my partners, we own 26% of the shares. So we're incredibly aligned, and I think that's a very important fact to point out. In terms of why now, so why would you invest in this trust now? We can talk about the discount, but let's talk about the asset class that we're in. We are in a small bank segment which benefits from the election of, whether you like them or not, Donald Trump and the Republicans in both houses of Congress. It's frankly irrelevant what you think about the man, because I would have my own misgivings about that, but the key is what kind of policy changes does it bring to the U.S. And we'll talk about tariffs in a moment, because that is obviously, we're seeing it in today's share price. The S&P 500 has come down quite a bit. It's bringing volatility to the equity markets. We're in the fixed income market, okay? Number one is, with both houses of Congress in the hands of the Republicans and Donald Trump as president, you will get a continuation of the low tax, corporate tax of 21%. In 2017, his signature legislation in his first term was to bring the corporate tax rate from 35% to 21%. Banks are corporate taxpayers. That certainty of that continuation of that, and perhaps making it permanent in line with most Western countries, is very, very important. So that's number one. Number two, and perhaps most importantly, is his deregulatory tone and approach. And what we think that's going to do in the small bank space is unleash mergers and acquisitions that have been, there's a pent-up demand. I've been calling it a coiled spring ready to release its energy. When I started in the asset management business, there were 25 years ago, there were 12,000 banks in the United States. It's a very different system than the UK. There's roughly 200 banks in the UK. There were 12,000. Now there are 4,600. And we think that number's going down to 1,000 over time. It's a secular consolidation in the business. And so why is that important if you own debt? So if Roland Bank and Neal Bank combine, if my debt that I issue is yielding, which it is in today's market, roughly 8.5% to 9%, and Roland Bank is 8%. He's a slightly bigger bank, maybe a better run bank. If we combine and we get the efficiencies of combination, which can be roughly 30% of combinations and costs, and what happens to the yield on that debt? It goes to 7%. So that's the capital appreciation. The value of that bond will go up because you have a better credit. It's not complicated. So the M&A that's going to happen under this administration in the next 2 years is going to be significant. The last 2 years have been the lowest M&A in the small bank space since the 1990s. So this is a pent-up demand, and banks know that Donald Trump only has one term. This is the time, if you're going to combine, if you're going to kind of move to your neighbor's area, get rid of branches, and expand, now's the time to do it. So that's incredibly important for the debt market in the small bank space. The third thing is we're having a steepening yield curve. And that's very important. Banks have been operating in an inverted yield curve over the last 3 years. So what does that mean? Why is that important? Banks borrow from depositors at one rate, and they loan out money, hopefully at a higher rate, right? That's the nature of a simple bank, right? This is not JP Morgan, this is not Wells Fargo. We don't own anything like that. We own the small banks that are quite simple SME, residential mortgage type issuers, lenders to real estate that's in small offices and small multifamily. That's what the small banks, they're community banks. And so when you have a yield curve that goes up, steepening, which is what we have, and I know there's going to be some volatility on like the 10-year right now and so forth, but the glide path of his administration, we believe, is lowering of rates on the front end and steepening on the far end, and that's what banks get their net interest margins, and that's how they generate profits and profitability, and that's why the debt becomes more valuable. The last thing is tariffs. That's like the number one question we get. How does Donald Trump and his kind of tariff, frankly, chaos and kind of inconsistencies and policy pronouncements, how does that affect the small banks? Well, it does affect the big banks, I would submit to you. I think there's a very different impact. The G-SIBs are globally systemic banks. They have 12% deposits are foreign, 17% of loan activity. And again, I'm taking those top 14 banks in America, the biggest banks. The small banks, however, are very domestically focused. They have less than 1% of their deposits that are from foreigners, and it's usually Canadians, which Americans kind of view on some days that we're the same. And then our loan activity of small banks is like 50 basis points. So they're very domestically focused. Now, all tariffs affect every player in the market, obviously, but some less than others, and we think there's a dramatic difference, and we think that this is actually the best Trump 2.0 trade. We're seeing the S&P at the time of his election, from the time of Donald Trump's election on November 4th, has been the same, but that's very different on the debt, and I think that's something that people should focus on. So I'll move off this slide. So again, I've spoken a little bit about EJF Capital, but again, $5.5 billion, $5.4 billion. We've been around for 20 years. Shareholder alignment, I made reference to this earlier, but we own 26% of the shares. I think that's incredibly important in the asset management business. We eat what we serve. And then we have a strong investor base, and you'll see that out of the top 5, 3 are UK investors. We've been here for a while. We've gotten some following with the likes of Premier Mitten, a UK insurance company, and these are all public information, and Newton, which is a Bank of New York affiliate here in the UK. So I think that's incredibly important. The second bullet. And I'll get a little bit into this before or later about the discounts quite wide. We've done a few things to try to bring that discount in. One of them is committing to take 20% of our management fee and invest it back in the shares, provide more liquidity, and what we do is we calculate what that is, and then Panmure Liberum, who's our broker, they go out into the market and buy it with their discretion. So we think that's incredibly important. The other thing is we put in, or I should say the board put in place in December, so it's new, a 5% liquidity provision per year. So up to 5% of the shares, people can basically tender their shares and get some liquidity. So we think that that's kind of a U.S. concept in closed-end funds that we're trying to bring here and say, look, this is a way to provide some way of bringing that discount in. So now talking about our assets. So in simple terms, we, at this point in time, and since we've been listed, it's been essentially some version of 65, 2/3 of the assets are in these small banks, insurance companies, and it skews heavy to the small banks versus the insurance companies. About 75% of that 2/3 is in small bank issued debt, so debt issued by the bank, not loans issued by the bank, but debt issued by the bank itself. And it's very important to understand what kind of debt this is, and that's true of the insurance companies too. They have to be, this debt cannot be issued by the bank or the insurance company without checking with their regulator. The regulator has to allow them to do it. They issue it for capital reasons, so it has to be approved. It's investment grade. So we sometimes, I think, inappropriately or inaptly get compared to structured credit CLO managers who are investing in high yield. So these are not investment grade loans to small companies that are high yield, meaning they're not investment grade. We're only an investment grade. That's the nature of the investments that we have. So that's why we like that kind of 9% annualized return and the dividend that we have that's very reliable. We've never suspended, again, 8 years, we've never suspended redemptions or dividends, we've never reduced dividends, we've never had a hiatus from making that dividend every single quarter, and we've raised it twice over the course of our eight years. And then 11% of our assets, approximately, are management fees. So these are the management fees for managing pools of assets. So these are affiliates of ours that we've taken, in the case of the CDO management fees, 49% and put it in the trust. And why is that important? Because that is not a credit risk, right? You're going to get paid that fee first in the waterfall, and so that provides regular cash and allows us to constantly, pay out our dividend. One of the questions I think Rebecca, and I really appreciated Rebecca's presentation, I learned a lot. That was one of the great questions, like, do you earn your dividend? And we do. We create the cash. We're not paying out principal. We're paying out what we're earning on our portfolio. So there's a lot of numbers on here. I promise I will not go through this in too much detail. I highlighted in a little bit brighter blue the two things I do want to talk about. There's 3 banking systems in America, those big GSIB banks, Wells Fargo, JP Morgan, and there's 14 of them. That's on the far right, the GSIB. Regional, that's the banks that are basically 100 billion to 250 billion. There's 27 of those. We focus on banks that are under 100 billion. So it crosses a little bit into the regional area, but our main focus is on these 4,300 banks in the small segment, and we really focus on about 1,000 of those. So since we've listed this trust, we've had 166 names, debt pieces issued by small banks. We've had 1 default in our 8 years. So we'll stand by our record. We're known as the small bank guys, or folks in the United States. This is what we do. We invest on the equity side in some of our funds. We invest in the debt in a large part of our funds, and then we have securitization vehicles that we manage that are, again, small bank and small insurance company debt. So just understanding the difference between the 3 is very important, especially as it applies to what I spoke about, M&A, which is the why now. M&A is going to be robust. I couldn't come up with a better kind of term for it. It's robust, and it's going to continue to be robust. Since the great financial crisis, roughly, on average, 5% of banks have consolidated, and they happen in the small area, not in the regional and not in the GSIB side. The regulators aren't allowing JP Morgan to merge unless there's a problem with the bank, and they make them merge. They're not allowing them to get bigger. But the small banks, I say the Democrats and Republicans can hardly agree on the time of day, but they can agree that community banks are important as a fabric to the fabric of their economic communities. And so they do want small banks, but you don't need 4,300 of them, frankly. It's better to have them to be less and to be more efficient. But this is really the catalyst why I would say this is very important to look at the trust. I've kind of gone through these points, but just to put a finer point on Trump 2.0, again, small bank M&A, the new people, and he doesn't need an act of Congress here. He doesn't need support from the House or the Senate or the Democrats. He's literally in the executive branch and in these agencies, he can appoint people. So Travis Hill is a good example. He literally came out and said, the FDIC, which is the main regulator for the small banks, that they're going to they're going to approve mergers. They're not going to stand in the way. And again, the Biden administration was very reluctant to approve mergers across the economy, but that banks were not excluded from that approach. They were very negative on M&A. The Trump administration, this couldn't be a bigger swing in terms of the pendulum. Extension of the corporate tax rate I spoke about. My view on tariffs, or the firm's view on tariffs in terms of the insulation and their domestic focus, and then the steepening yield curve. So this is just, again, a lot of numbers, but the main point is that under Biden, it's been extremely aberrational in terms of the only 500 banks merging under his watch, contrasting that with prior administrations, and the time frame to get these done is also taken longer. So again, these slides will be available, I believe, to everybody here. You can kind of go through the numbers in painful detail if you'd like, or if you have a bout of insomnia, you can go through all these numbers. But so why in financials now? Now this, I think people find it surprising because I find a lot of retail investors, a lot of our high net worth investors are heavily skewed to tech companies and growth because it's exciting, it's interesting, right? But they kind of forget that financials are actually a big part of the market, and they're underweight that. So I just wanted to, for those who aren't aware, that represents 14% of the S&P 500. The FTSE 100 has 5, but look at who the HSBC alone is 7% of that. It's 7 out of that 11, right? If you have the FTSE 100 index, you got a lot of HSBC. You don't have a lot of other financials, particularly smaller banks. You have these big banks that are listed there, and then if you look at HSBC's report on high net worth and what are they thinking about doing coming into 2025? They want to increase their exposure to U.S. assets, and I know that's somewhat surprising, but those are the numbers. And 24% want to increase to private credit, and we would call what we do is regulated private credit. And one thing, just stepping back, private credit, a lot of headlines, you're reading about it in the FT, Wall Street Journal. A lot of private credit funds, the amount of money that's gone into that, you know why that is? It's because it's been pushed, a lot of this lending has been pushed out of the banking system. The underwriting standards that the regulators have put in place have been incredibly heightened since the crisis, because that was an asset crisis. The banks now have higher capital levels, higher underwriting standards. The next slides I'm going to go through, because I only have 3 minutes till questions. I'm not going to go through these in painful detail, but they'll be available for you. But what has happened since the great financial crisis has really made banks strong. Some would say maybe too strong on some level in terms of their taking risk. But private credit is the best example or the best evidence that a lot of lending has been pushed out of the banking system, the riskier bit. And my prediction for something bad happening, it would be a private credit fund blowing up. Like, that will happen. You can bank that, and I think I'm getting taped, so you can throw it back on my face. So again, I'll point to the bottom chart. It's just basically that banks' balance sheets are in a stronger place. Basically, the write-off of bad loans is in a trough period. We get this question a lot, so I just put a slide in here about kind of what happens in the real estate area. In banks' exposure, there's always a Bloomberg article about this. You can see that during the great financial crisis, that's that big hump. It was an issue, and certainly it's a muted concern in today. This just shows that when they test banks, when they do the regular post great financial crisis testing of banks' balance sheets and their performance, they take a 7% loss rate, which is higher than the great financial crisis, which is that hump there. And banks have passed that. I do think that what was needed was higher regulation, and we certainly got it. And I think this is a prudent way to look at banks and impose a higher rate than the worst case scenario, which was 2007, 2008. This chart just focused on the blue line. This is just saying that's the number of banks that have been around, and there's no new bank charters really being put out there. They're just consolidating. So you want to own that debt. This is my again. You can look at it at your leisure, but this is just showing that the amount of lending that's gone into shadow banks, which are private credit funds, other vehicles that are not regulated banks, that's increased dramatically. Now the portfolio, which I have 1 minute before questions, but so this is a very important slide. So again, this is the first, the 65%, that first thing. That's our triple B, that's investment grade, triple B minus. That's 65% of the portfolio, throwing off a gross yield of 13%. Then we've got the management fees that are 11%, which are above investment grade because they're paid first in the waterfall. And then we've got cash and cash equivalents is really the rest of what we had for the most part. And that's because we have a zero bond that's due in June, and we need to have enough cash to have that pay off if it doesn't completely roll over. So let me go back. So I'll end actually here. So what are the risks? If I don't talk to you about risk, I think Rebecca did a good job talking about the risk of her portfolio. Liquidity is modest. That's admittedly true. It just if you're going to buy 2 million shares, that's one issue. If you're going to buy 100,000 shares, that's a different issue. There is liquidity certainly at that level. Our average daily trading volume in the last 3 months has been 34,000 a day. So that's kind of the risk. The liquidity, and then risk mitigation. Again, I mentioned this, but it's worth mentioning again. We have a big discount, so you're getting paid for that risk. Number two, we have that 5% liquidity, annual liquidity tender mechanism that's just been put in place. And then the manager, we're just showing our commitment to this thing. We are taking our management fee and buying more shares to provide more liquidity, and again, help close that discount. So I look forward to Roland's questions and the audience questions, and thank you very much.
Thank you, Neal. Thank you. Terrific. Okay, do you have any questions for Neal, please? If you have, down here at the front again.
Will I go?
Oh, sorry, yes, I didn't see you.
Yeah,
please
sorry.
go ahead. Yeah.
I'm just interested. It was a fascinating presentation, and I understand if you're a retail investor why you might be very interested in it as far as the yield's concerned. I assume it's dollar risk. Is that right?
It is. It's a very good point. We are denominated in pounds in our listing.
Yeah.
Our assets are dollar, but we hedge, and that's a very good point. So our historic amount has been basically 50%. We hedge, and we hedge at least the amount of our debt that we owe, and that's about 30%. So we're always at least 30% hedged. But we basically keep it about 50%, 50-50. And it's kind of, we've looked at it, and we're not FX traders. We're just trying to kind of modulate that risk. So it's kind of come out like some months you're up a little bit because of dollar exposure, some months you're down. It kind of works itself out, and we've been about 50-60% hedged.
So let me ask a real question now. So you're a $5 billion fund, and it's 100 million on London Stock Exchange. Why are you here, and what? I understand from the retail side, but why are you doing it?
Well, that's a very good question, and I'll try to give the non-complicated answer. So legally, if we wanted to list this, if we cannot list it in the United States because of the 40 Act, the 1940 Act, which is a mutual fund provision. Here, the investment trusts are actually, you can do slightly more creative things, and you can also, so for our case, when we do what we basically do is we buy these pieces of debt that we like, that's that 166 figure I mentioned. We get leverage on those 2 to 3 times through a securitization, structural securitization, term financing that's match funded. So it's not like you get a margin call. It's like if the asset's 8 years long, we get 8 years financing, and we sell the debt to the market. Usually it's pensions and insurance companies. We keep that equity bit, and in America, that just by doing that, you would violate the 40 Act. And they made a mistake when they did. I'm an ex-lawyer. I'm sorry. I'm a recovering lawyer, 9 years before I got into asset management. I was a securities lawyer. I was at the SEC, so the space I actually know. And they just, when they passed Dodd-Frank after the crisis, they forgot to say, but you can do risk retention in a public company in the U.S. So that's why it's really in the weeds. But like Blackstone Group, they have BGLF. You might be familiar as an investment trust. They were the first ones to do it, and frankly, we didn't dream it up. We followed their lead, and that's why we're here. But it's incredibly important to us. So our balance sheet at EJF Capital is 130 million, and we've got 26 million quid. That's dollars. $130 million. 26 million quid is in this. So we like it for our business. I mean, it just throws off that nice yield. I mean, it's steady Eddie, risk return. It's not sexy, but the risk return ratio is favorable, I'd say.
Other questions for Neal? Otherwise, I've got one here. I wanted to ask about the tender offer that you have here. Would that be open to all shareholders?
Yes, yes. And the board, and again, we're just trying to take a U.S. closed-end fund concept and trying to impose it. I mean, other people have done tenders. I'm not going to say, but doing it systematically every year. And the board got approval for 5 years. I guess under the UK code, you have to do it 5 years at a time. But I would hope that we would have this permanent, because you want people to have liquidity. I mean, you don't want them to get in something and feel they're stymied and they can't get liquidity for whatever they need. So we thought this was an innovative way to provide some liquidity, and it's up to 5%. So EJF Capital, we will not be submitting, for liquidity. So 74% of the shareholders can put in for 5% or maybe a little bit more, because the limit is 5% overall, not 5% per shareholder.
Thank you. Please.
Yeah, thank you. Hello. Thank you for the presentation. A couple of questions based on the tender. So how are you paying for the tender? Are you paying out of your earnings, or are you paying out of capital? And are you cancelling the shares or keeping it in treasury? And then don't you, if you're not tendering shares, don't the management get creeping control? Because you're at 27% already at the moment.
We can and we can't, because as you know, as you may know, there's a 30% takeover provision in the UK.
Precisely.
Yeah, so we can't exceed that.
So if people give 5%, then you will exceed it. Your percentage-wise, in a couple of years, you'll be above 30%.
No, it could, and then we'd have to go to the takeover panel and ask for permission. So we'll see, right? But it won't happen. It wouldn't happen for a number of years, like 2 or 3 years, even if everyone put in for a redemption, which or for a tender. In terms of it's from capital or cash available capital. It's not new money coming in. And those shares would be retired, not put in treasury, I believe. I probably need to double check on that.
And the tender price would be the asset value, would it?
That's up to the board, and it doesn't have to be at NAV. I think the public announcement we put out said it can be up to NAV, but it doesn't have to be at NAV. That they didn't. They provided some flexibility, I think, to kind of deal with whatever the market situation is.
Okay, I mean, I like what you're doing, but as you heard me say, your spread is so wide. If I invest in you, I instantly lose 10%. And what are you doing to address the spread?
I unfortunately, that's one I don't have a great answer to. I mean, I think you should petition Panmure Liberum to close the spread. No, I understand why that's irritating, but I will say it. Look, we were at a 42% discount. I mean, for a fixed income, one default over 8 years, great performance in my view for what we do. And we were at 42%. Now we're at 25%. So by talking to folks, I've done a couple CityWire interviews. Maybe I shouldn't say that here on this podium, but just trying to talk to investors and get them interested. I think we've closed it like 23% in the last 6 months.
I mean, I have invested in similar things. I'm invested in Fair Oaks, so I understand.
Yeah, Fair Oaks is great. Yeah, great.
Very
different than us.
Lovely dividend.
Yeah,
but,
yeah. No, I love Fair Oaks, and they're different than us. They're that high yield. And again, I wouldn't say like buy us over Fair Oaks. We're a good complement to that. We're different. We're more put your head in the pillow and not worry about it as much. Fair Oaks is going to be, we'll see what happens in a deep recession. Banks don't go under in recessions. They go under in crises. And in my life, I wasn't, there was the savings and loan crisis. There might be some people who are old enough to remember that. That was a real crisis, right? Savings and loan, great financial crisis. Great Depression, which no one in this room is old enough to remember, right? So, but you know about it, right? Those are when the banking system, if you don't know what you're doing, it doesn't matter, or you do know what you're doing, you're going to get hurt because everyone gets hurt. But we just don't see that with the way underwriting standards and regulations, and we just don't see that around the corner. So we're very confident to say this is our best idea, risk-reward, favorable ratio.
I have another question, Neal, if I may. How long do mergers typically take for smaller banks? And if you have that one term you spoke about for Trump's period in office, and are there any signs those conversations have started amongst those banks? We've been waiting for that sort of opportunity.
Yeah, it's already happening. So there's been a since the election, there has been heightened issuance of the bank-issued debt that we buy. That's good. It's been coming in at a higher rate because it's not economically driven, like this is the best rate we can get. It's regulatory driven for building up capital. And before you merge, you have to go into the regulator and they ask what they know what your capital levels are, but you have to have heightened capital levels before you merge. So a lot of them are issuing it for regulatory reasons, not economic reasons, and that's always a favorable trade. So in terms of timing, it can take, it was 151 days under Joe Biden on average. This is on average 129 under Barack Obama, 138 under Donald Trump. But I think that the key is just the pure number has gone way down, but the timing has been a little bit delayed, but that's not dramatic, not totally dramatic.
Lovely, Neal. I think we're going to say time there. Thank you very much indeed for joining us. Thank you for presenting. Really interesting. And just to say on that, if you're not familiar with it, the ticker is EJFI. If you want to look for it on the AJ Bell platform. Our next presenter this evening, we have Dan Higgins, who'll be talking.